Okay, so you're an entrepreneur, maybe a freelancer, or perhaps that side hustle is finally, really bringing in some profit. And then tax season hits. That feeling, yeah, we know it. You came here looking for quick, deep knowledge, and that's exactly what we're aiming for today. We want to turn that complicated tax code into a real secret weapon for you, like a lifelong blueprint for actually protecting your wealth.
That mental shift is absolutely key. It's often the hardest part. Our sources, they all pretty much agree. Taxes are meant as punishment. Think of them as incentives. Seriously, the tax code is written to encourage certain things, creating jobs, R&D, innovation, investing capital. But the raw truth is, if you're passive about it, if you don't have a real strategy, well, you're basically signing off on losing 30, maybe even 50% of your profits. Gone.
Wow, 30 to 50%. That's huge. And it's not because of audits necessarily, just bad structure.
Mostly bad structure or lack of strategy. We're talking optimization here, 100% legal. And the potential upside is massive. You could genuinely cut your effective tax rate by, say, 10, 20%, maybe even more once you get these strategies rolling.
Right. It reminds me of that quote from Tom Wheelwright.
Exactly. He nails it. You're not broke because of how much you make. You're broke because of who's taking the first cut. And so the goal isn't just nickels and dimes. It's structuring things so the government takes the last cut, not the first. So today, we'll cover the foundations of the entity structure. Then we'll dive into core strategies, deductions, credits, and then some more advanced tactics too. Stuff that can scale with you, whether you're just starting or pushing towards 7 figures.
Okay, let's lay that foundation then. Section 1, getting the structure right. You said the business entity is like a tax shield. Choosing wrong sounds like it could be expensive.
Oh, absolutely. It really sets the stage for everything else. It's probably the most common big mistake we see. So if you're starting out, maybe a side hustle, making let's say under $50 a year. Yep. The sole proprietorship or a single member LLC, taxed as one, is simplest. Income just flows to your personal return. Schedule C. Easy.
Okay, simple sounds good, but what's the catch?
The catch is that self-employment tax, the SE tax.
Ah, yes, the SC tax. Let's unpack that because, like you said, it feels like a silent killer for profitability.
It really is. It's 15.3%. That covers your Social Security, Medicare. Now, if you work for someone else, your employer pays half of that. But when you're self-employed, you pay the whole 15.3% on every single dollar of profit.
Ouch. Okay. So that 15.3% on all profit makes that simple structure pretty painful once you start making real money.
Exactly. Once profits climb, maybe past $100,000 consistently, that structure just gets too costly, becomes punitive.
So what's the pivot? What's the standard game changer move entrepreneurs make then?
Almost always, it's the S-Corp election. You can elect this status whether you're set up as an LLC or a traditional corporation. And here's why it's critical. The S-Corp is a pass-through entity, but it works differently. You, as the owner-employee, pay yourself a reasonable salary. Now, that salary is subject to payroll taxes, just like a regular job.
Okay, so payroll tax on the salary part, but what about the rest of the profit?
Ah, that's the key. The remaining profit. You can take that out as a distribution. And those distributions, they are not subject to that 15.3% self-employment tax.
Okay, that's the magic part. So you save potentially 15.3% on a big chunk of your profit.
Exactly. Huge savings potential. Zach Mello, a CFP we looked at, he actually called it the best tax deal in America.
Oh.
You can easily save, 15% on maybe half your profits. That adds up fast.
That sounds amazing, but it almost sounds too good to be true. I imagine the IRS watches this closely. That reasonable salary part seems tricky.
Oh, they watch it very closely. It's a major audit trigger for S-Corp. The number one red flag is paying yourself a salary that's clearly way too low for the work you do compared to your industry. You absolutely must document how you arrived at that salary. Use industry benchmarks, data for similar roles in similar companies. If the norm for a CEO running a $300 go business in your field is $80K and you pay yourself $30, you're asking for trouble.
Right. Documentation is key there. Okay. And just quickly, the C-Corp, who's that for?
The C-Corp is typically for businesses aiming for really rapid scaling, maybe looking to raise venture capital or planning to reinvest most profits back into the business. The big downside is potential double taxation. The corporation pays tax first, currently 21% federal. Then you personally pay income tax again when you receive dividends from those already taxed profits. But it does offer more flexibility for certain fringe benefits and allow of keeping earnings in the company potentially taxed at that lower corporate rate.
Got it. So regardless of which structure you choose, sole prop, S-Corp, C-Corp, there's one rule everyone seems to agree on.
Absolutely. The golden rule, non-negotiable for audit-proofing and sanity. Keep business and personal finances completely separate. Get dedicated business bank accounts, dedicated business credit cards, everything separate. The Taxpayer Advocate Service stresses this too. It makes tracking deductions way easier, obviously. But just as importantly, it protects your personal assets if the business gets sued or runs into debt. It's fundamental.
Okay, foundation laid. Let's move into section 2, core strategies, the daily plays. But first, maybe just quickly clarify again the difference between deductions and credits. It trips people up.
Good idea. So deductions reduce the amount of your income that's actually subject to tax. If you earn $100K and have $20K in deductions, you only pay tax on $80K. Simple enough. Credits, though, are much more powerful. They come off the top of your actual tax bill. Oh, $10K in taxes. A $2K credit means you only pay $8K. Dollar for dollar reduction. Much better.
Right, credits are king. Okay, so what are those bread and butter deductions everyone should be using?
The home office deduction is a big one, surprisingly underutilized sometimes. People get nervous about it. But if you have a space in your home used exclusively and regularly for business, you can deduct a portion of your home costs. Think rent, mortgage interest, utilities, insurance, based on the square footage of your office relative to your home. Or there's the simplified method, $5 per square foot, capped at 300 square feet. Easier, maybe less deduction though.
And wheelwright's advice applies here too, right? Think like a strategist daily.
Exactly. Don't just think about taxes in April. If your home office is genuinely where business happens, those associated costs, electricity, internet, partially become business expenses. It shifts costs you'd pay anyway into the deductible column.
Okay, what about cars? Vehicle use is a huge expense for lots of businesses.
Yeah, another potential gold mine if you track it properly. Two main options here. You can track actual expenses, gas, oil changes, insurance, repairs, depreciation, the whole 9 yards. Or you use the standard mileage rate. For 2025, it's projected around 65 cents per business mile. Honestly, the standard rate is often simpler and frequently gives a bigger deduction, unless you're driving something really expensive or fuel hungry. But the key, the absolute key, is meticulous records, a detailed mileage log. Apps help a lot here.
Right, logs. Okay, equipment. You mentioned Section 179 earlier as a way to accelerate deductions.
Yes, Section 179. This is a fantastic tool for cash flow management. Normally, when you buy a big asset, computer, machine, furniture, you depreciate it. You write off a bit of its cost each year over its useful life, maybe 5 or 7 years. Section 179 lets you say, nope, I want the deduction now. You can deduct the entire purchase price up to a pretty high limit, like over $1 million in the year you actually buy it and put it into service. Huge immediate tax saving.
Okay, that's powerful. Now, one that always sounds a bit edgy, but apparently isn't, hiring your family.
Yeah, it sounds like a loophole, but it's a legitimate income shifting strategy. Perfectly legal if done right. You hire your kids, for example, to do real work for the business, cleaning the office, website updates, filing, whatever is appropriate for their age and skills. You pay them a reasonable wage for that work.
And the benefit is?
Twofold. First, the business gets to deduct the wages paid, reducing its taxable income. Second, you shift income from your likely higher tax bracket to your child's potentially much lower, maybe even zero tax bracket.
But what stops you from just, paying your kid $50 for emptying the trash? How does the IRS view this?
Great question. It has to be bona fide. The work must be real, necessary for the business, and actually performed by the child. And the pay must be reasonable for the task performed. You can't pay $100 an hour for filing papers. But here's the kicker. If you operate as a sole prop or partnership, where both partners are parents, and you pay your child who's under 18, those wages are generally not subject to Social Security and Medicare taxes, FICA, and often not federal unemployment tax, FUTA, either.
Wow, so no payroll taxes on top. That 15.3% SE tax disappears for those wages.
Exactly. That makes it a really clean way to keep more money within the family unit legally. Yeah. Oh, and one more deduction we absolutely have to mention for the self-employed: health insurance premiums. If you're self-employed and not eligible for an employer's plan elsewhere, you can generally deduct 100% of what you pay for health, dental, and qualified long-term care insurance for yourself, your spouse, and dependents. It's an above-the-line deduction, so it directly reduces your adjusted gross income.
That's a big one, too. Okay, let's shift to those power credits, the actual free money.
Right. The R&D, credit research and development. So many small businesses think this is just for big pharma or tech giants. Not true. It can provide a credit of up to 20% of your qualified research spending. And research can be broader than you think. Developing new software, even just for internal use, improving a process, experimenting with new materials or formulas. A lot of activities can potentially qualify. Many tech startups, service firms, even breweries or manufacturers miss out on this entirely. It's a direct cash credit.
Worth investigating then. And for those pass-through entities, the LLCs, S-Corp, sole props, there's that huge deduction we mentioned.
Yes, the Qualified Business Income QBI deduction, sometimes called Section 199A. This is huge. If your business is a pass-through entity and your personal taxable income is below certain thresholds, you can generally deduct up to 20% of your qualified business income. There are complexities, especially for certain service businesses above the income limits, but for many, it's a straight 20% haircut off their business income before tax is calculated. Massive.
Okay, and before we get to advanced stuff, the ultimate tax deferral, retirement accounts.
Non-negotiable. Absolutely critical. Using retirement accounts like a SEP IRA or a solo 401k is one of the best breaks available. You can contribute really substantial amounts. A SEP IRA allows up to 25% of your compensation, maxing out around $69,000 for 2024, depending on structure. A solo 401k has similar high limits, potentially even higher if you make both employee and employer contributions. Those contributions are tax deductible now, reducing your current tax bill, and the money grows tax deferred or potentially tax-free in the case of Roth versions until retirement. Like Unker and Paul pointed out, the tax code really does seem written to specifically favor business owners who utilize these tools.
Okay, we've got the core down. For those scaling up, wanting to protect bigger profits, let's hit Section 3, advanced plays and mindset.
Right. Moving beyond the basics. First up, a simple but effective tactic. Year-end timing. It's all about managing cash flow and taxable income across calendar years. The basic idea. If possible, try to defer income into the next year. Maybe send out invoices in late December that won't get paid until January. And conversely, accelerate expenses into the current year. Need that new laptop or piece of equipment? Buy it and place it in service before December 31st to get the deduction this year. It's legal timing management.
Makes sense. Control what you can control. Now, that more complex one involving real estate, cost segregation. Sounds technical.
It is technical, definitely not a DIY thing, but it can be incredibly powerful if you own business property, like an office building, warehouse, or even a rental property. See, when you buy a building, the standard depreciation schedule is really long, like 39 years for commercial property. Slow write-offs. Cost segregation uses specialist engineers to analyze the building's components. They identify parts of the property that can legally be depreciated much faster.
Faster depreciation, like what kinds of things?
Things like carpeting, special electrical wiring for equipment, plumbing fixtures, decorative lighting, even landscaping or parking lots. Instead of being lumped into that 39-year building category, these might qualify for 5, 7, or 15-year depreciation schedules. What this does is front-load your depreciation deductions into the early years of owning the property, which means much bigger tax write-offs now, improving cash flow significantly.
Okay, powerful, but definitely sounds like you need experts involved to do it right and defend it if the IRS asks questions.
Absolutely. You need a reputable firm that does a detailed engineering study and provides thorough documentation. But as Wheelwright often emphasizes, using strategies like this with real estate is a classic way the wealthy build and protect assets over the long term.
Okay, shifting from tactics to mindset and protection. Audit-proofing, we're optimizing legally, but we still need to be prepared. Key habits.
Consistency and record keeping. The standard advice, keep everything for at least 7 years. Bank statements, invoices, receipts, expense logs, everything. Digital backups are essential. And, as Nationwide advises, hire a good CPA or tax advisor early. Don't wait until there's a problem. A proactive advisor helps you structure things correctly from the start, not just clean up messes later. They should be a strategist, not just a form filler.
Yeah, the sources even use some fun Hollywood analogies for documentation. What's the lesson from, say, Catch Me If You Can?
Right. The lesson isn't to be Frank Abagnale, obviously. Don't forge anything. The takeaway for entrepreneurs is about the appearance and substance of legitimacy. You need to meticulously document every single deduction as if preparing for intense scrutiny. The IRS might not question a receipt itself, but they'll question the business purpose if you can't prove it. Claiming travel. You need detailed logs. Who, what, where, when, why. Dates, destinations, business discussed, not just a plane ticket stub.
Right. Build the legitimate paper trail. And what about the line between optimization and illegal evasion? Thinking the firm or even Al Capone?
That line is crucial. Ethics matter immensely. Big corporations use S-Corp, retirement plans, fringe benefits all legally. Small businesses can and should too. History teaches us optimization, using the code as intended, build sustainable wealth. Evasion. Well, Capone wasn't jailed for murder, he was jailed for tax evasion. The Untouchables showed that. Always file your returns, operate with clean intent, and back it up with flawless records. If you get audited, that documentation is your defense. Victory lies in the paper trail.
So, wrapping all this wisdom together, what's the core message for long-term wealth building through tax strategy?
It boils down to consistency. It's not about finding one magic bullet. As Will Wright says, wealth isn't built with one big tax move, it's built with 100 small ones. It's about embedding these strategies into your regular operations. And maybe think globally too, like Peter Level suggested for Nomad Entrepreneur structure as a company. Pay corporate rates where applicable. It's about proactive, habitual effort.
Right, so this knowledge isn't just interesting, it's about putting yourself firmly on the side of legal, defensible optimization. Intent is key, but proof is everything.
Exactly, and it's not just theory. This needs to become an actionable plan for you.
Absolutely. So let's give you a clear roadmap. Don't just listen, do.
Okay, month 1. Nail the foundation. Choose or confirm your entity structure based on profits. Open those separate business, bank, and credit accounts. Start tracking every expense daily if possible. Use an app, use a spreadsheet, whatever works. Then, quarterly, sit down and review. Look at your deduction categories. Are you maximizing them? If you're an S-Corp, run payroll correctly. Make those retirement contributions consistently. Don't wait till year end. And annually, meet with your CPA before year end for strategic planning, not just after for filing. Review everything. Discuss entity changes if needed. Consider advanced plays like cost segregation if appropriate.
Following that kind of roadmap, the goal seems realistic. Maybe a 10% cut in your effective tax rate in year 1, possibly 20% by year 3 as you layer in more strategies. This really does shift the tax code from feeling like an enemy to, well, maybe an ally that rewards smart business moves.
That's precisely it. It captures what Wheelwright means by tax strategy is how entrepreneurs legally fire the government from their profits.
Legally fire the government from their profits. Think about that. What could you do with an extra 10%, 15%, 20% of your profits, compounded year after year, reinvested, used for growth, building real wealth? So the final question for you is, what's the very first action step you're going to take today to start implementing this plan and legally fire the government from your profits?